Why the US dollar weakness is a bigger deal than it looks. Market overreaction in the short term, but a strategic advantage for BRICS nations. Your purchasing power just took a silent hit this Christmas morning as the US dollar experienced an unprecedented flash devaluation on global exchanges, dropping nearly 10% in value against emerging market currencies while you were opening presents. While the U.S. government points to a 4.3% GDP growth rate as a sign of strength, the global market is sending a different message. The era of the unquestioned dollar is officially over. This sudden currency shifts a market overreaction in the short term, but a short-term win, long-term risk for the U.S. economy as a whole. The American consumer absorbs the cost. A weaker dollar means every gallon of gas and every imported holiday gift is about to get more expensive, even as your official inflation numbers claim everything is under control. Here's what happened. Global investors are terrified of the new U.S. sanctions policy. On the Moscow exchange today, the dollar plummeted to 78 rubles. Not because Russia's economy is strong, but because the world is dumping dollars to avoid having their assets frozen by Washington. We are seeing a mass exodus from dollar-denominated holdings. Central banks in Asia and the Middle East aren't planning to diversify. They are already doing it, moving record amounts of capital into gold and alternative currencies. This is geopolitical hedging in real time. The US dollar is no longer just a currency. It's a membership card to a club that half the world is trying to quit. The GDP paradox, aggressively scope. Focus on the inflation lag. How can the US economy grow at 4.3% while the currency falls? This is the inflation lag. We are growing because Americans are spending money as fast as they can before it loses value. This isn't wealth creation, it's velocity of desperation. The Federal Reserve is trapped. To save the dollar, they need to keep interest rates high. But to keep the 4.3% growth alive, they need to provide liquidity. They are trying to walk a tightrope over a canyon of sovereign debt, and the wind is picking up. The fintech off-ramp. Look at the behavior of the fintech sector. Companies like Mastercard and Visa are no longer just processing dollars. They are building cross-border rails for stablecoins and digital assets. They see the writing on the wall. They are behaving as if a multipolar currency world is already a reality. If the big banks are building lifeboats, it's time to stop ignoring the water on the deck. Watch the January 15th Treasury report. If foreign ownership of U.S. debt shows another 5% drop, the market overreaction will turn into a permanent supply chain contraction. The dollar isn't going to zero, but its days as the only game in town are finished. This story is still unfolding. If you want to understand what's next and who pays the price, subscribe and stay with the channel.